Oh, here comes some people. Hi, guys. Welcome.
Hello, everyone.
Hi, Ellen and Chris, Janice, Michael, Sharon, Stephanie, Sue, Terry, here everybody comes in.
Hello.
Hi, guys.
Hi, everybody.
Hope you all had a nice Monday.
Hi, Alan. Nice to see that you're on here.
Hi, Nancy. Mike and Pat, Michael.
Hi, Steph.
David.
You guys can use the chat. The chat at the bottom, you can put your cursor over it and write us anything like what did you do this week? Anything out of the ordinary? And what are you drinking tonight? I'm drinking my tea from this morning.
Someone raised their hand.
Hi, Kathy. Oh, someone raised their hand. Oh, they're saying hi.
Yay. Hi. Yeah. Joe and Judith.
They're waving.
Hello.
Hi, Teresa.
Hi, Steph. Hi, Sharon. Hi, Paul.
And Terry, Mike and Pat.
Not quite sure who owner is. Let me know your name for the wine drawing.
And
yes.
Michael. Hi, Michael.
Hi, Horace.
Hi, Marcy.
Ooh,
Yeah,
Horace went hiking yesterday. Awesome.
Where'd you go?
Perfect.
Where would you go hike? Where were you hiking, guys? You're kind of up in my neck of the woods, you know. Red wine, yay.
Red wine.
Cheers.
Speaking my language.
Hey, Paul.
Oh,
Picacho Peak. Wow.
Hey, Don and Rick. Nice.
Yeah. Awesome. All right.
Down
Well, we
south.
probably got a couple more people.
Hi, Brenda and Sam.
Got a few more people strolling in, and while everybody is
Even
coming on
Dynamite
in,
Trailhead.
while
Awesome.
everybody's still popping in,
Close to my hacienda.
we'll go ahead and get started a little bit with a little bit of bantering and chit chat and the topic of the day, which I like to do. Again, I'm Kelly Gollner, the marketing director for MoneyWise Retirement Planning with Christina and Nancy. And today's day of the week it's actually Play More Cards Day. So I thought that was kind of appropriate because I don't know about all of you, but I love to play cards. There's Nancy. Nancy likes to play cards.
No, I have my daughter made me bags. If you can see this, I don't know if you can see it, it says 12 decks. I've got a baggie of 2 decks, 3 decks, 4, 5, 6, 7, 8, all the way up to 12 decks.
That's because there's a game we like to play called Hand and Foot. Do any of you play it? Anybody?
Skip-Bo. I've heard of
It's
that.
fun. Skip-Bo. I like Skip-Bo. But well, I thought that was kind of interesting when I was researching Play More Cards Day, that first of all, bicycle cards was created in 1885. I didn't realize they were that old. And I thought this was really cool. In World War II, they made a deck that was designed as a puzzle. And the puzzle, when put together, became a map to help potential prisoners make their way to safety if they escaped. I thought that was kind of genius. I don't know whether or not it worked, but I thought that was really kind of a clever idea that they did with the cards. Kind of fun. Yes, that's true, Chris. They were good for noisemakers and bike spokes when we were kids.
That's for sure. That was fun.
Who didn't do that with clothespins, right? That sound. Yep. And then the war also is what prompted Bicycle to make their cards waterproof so that the soldiers could play them when they were in the mud and the water, and the cards would last. So I thought that was kind of interesting.
Wow, thanks for
tidbit
that.
I would share with you all. So you guys all get out there and play more cards today while you're drinking your beverage of choice. I'm drinking water tonight, unfortunately, because I'm
Me
still
too. Me too.
But that
Good
doesn't mean I
evening,
won't
Dave
have
and
you later.
Pam.
So anyway, I know that Christina has quite a bit to talk to us about tonight. Our topic tonight on Happy Half Hour is structured notes. I just want to let you all know, because some of you have already registered for the next happy half hour on February 21st. And that topic is going to be about the psychology of money, which I think will be a very interesting topic, because I do think there's a lot of psychology to money. So without further ado, I'll come back in a little bit later, as I always do, to chit chat with you more. But in the meantime, I'm going to pass it on over to Cristina to go ahead and talk about structured notes.
Thanks, Kel. Good afternoon, everyone. For those of you who I have not met, Cristina Acosta with MoneyWise, and today I'm going to be a little bit more specific in the topic in regards to investing. Many of you on this Zoom have familiarity with this particular investment, but we oftentimes get requests of, can you go into a little bit more detail of behind the scenes how this particular investment works? So the investment is structured notes. And as I go through my talk, Nancy will be monitoring the chat. So be more than happy to address any questions that you all may have. So let's talk about structured notes. What are they? Not very many people, Nancy and I find, that are familiar with these or even have them in their accounts. So the reason why we've incorporated them into our clients' portfolio is because they're a great alternative way to accomplish two of the biggest obstacles that all investors have been challenged with over the last couple, 2-3 years, and that's yield. And what's yield? Is just interest, right? The interest that we can make on our investment, coupled with how to better manage volatility. So the structured notes very nicely marriage those two objectives together. But the important thing to understand with any type of investment that you would consider is you always want to know that there is an issuer or a backer to the investment that you're considering. So for example, you invest in a stock, okay, you invest in Tesla. You are going to be very interested in how Tesla is doing, and you're going to pay more attention to Tesla, right? That's the issuer of that stock. If you are investing into real estate, you're going to be very attentive to what's going on in the real estate market, to valuations, interest rates, things of that nature. Structured notes are no different. So the issuer of structured notes are large investment banks like Barclays, Citigroup, Morgan Stanley. Okay, so I want to first, before I give you an example, is I want to give you the characteristics of what a structured note is. So a structured note really is a combination of some type of a fixed income security, like a corporate bond, okay? Coupling that with an equity in regards to a market index, like the S&P 500, or an individual stock, like a Costco. So it's really marrying those two types of underlying assets, like a corporate note and an equity, like a stock. And there's a reason why those two are married together. So what's important to understand, because oftentimes when I say note, oftentimes people think, okay, is it like a bond? Well, the primary distinction between a structured note and, say, a corporate bond is a corporate bond or any fixed income type of investment is going to be interest rate sensitive, okay? It's tracking a fixed income market. Whereas in a structured note, we're not tracking the fixed income market. We are tracking the equities market in the form of an index like the S&P 500, or in the form of a stock, an individual stock. So that is called what's the underlying asset that this note's tracking in order to produce the rate of return. And again, it's either an exchange traded fund, an index, or it's going to be an index, or it's going to be an individual stock. Okay, so that's the first characteristic of what does it track. The second is the term of the note. Many of these notes in the big picture of investing, because we all know investing 101 is for the long term, but all these structured notes have maturity dates, and they could be anywhere from 12 months to 5 years. Okay, so there's a variety of options depending on a person's time horizon. Okay, And then there's what's called your coupon. Your coupon is just your interest rate. What is this note going to pay in interest throughout the term? And some of them pay, or I would say most of them pay monthly. And that's what we typically look for our clients, is generating monthly interest. Some pay quarterly, okay? But the unique thing of these structured notes, and the reason we've incorporated them into our client's portfolio, is they have what's called a coupon and a principal protection barrier. Okay, so think of this very simple as a cushion. Okay, you're going to have some protections to the interest that you can earn and to your principal. Okay, and that's very, very key, because again, it's great that we find some wonderful yields. And for those of you who have been in these structured notes over the past 12 to 18 months, have been enjoying some wonderful yields. But we also want to be mindful of protecting your principal. Okay, so these are how these notes are structured and the characteristics of the notes. But what I'm going to walk you through is how the interest and your principal is looked at over the course of the time period that you're in these notes. Okay, so I'm just going to share with you my whiteboard. I did a very, very rustic depiction of how these notes work, just to kind of give you a flavor. But we can certainly go into more specifics. We have availability of these notes, quite frankly, on a weekly basis. But I'm just going to give you a general explanation here. So let me kind of break this down for you. This is going to correspond to the characteristics of the note that I just went over. So what's the underlying asset that this note's going to track? Well, here it is right here. SPX, that's the S&P 500. RTY, the Russell 2000. So this is the underlying asset of this example. Okay, there can be different indexes. Some of the notes that we look at track actually individual stocks. Okay, so what's the term? Remember, that's another characteristic. Well, this is a 12-month note. Okay, and I'll explain how that works. What's the coupon? Well, it's a 12-month note, and it could pay 2% every quarter. Okay, so over the course of this time, if it pays interest every quarter, you have 2% a quarter. So we could potentially see an 8% yield on your principal if the note went to this full maturity. So this is how it works. On day one, we know the value of the S&P and the Russell. Okay, day one. And then it's moving up and down every single day, as you know. So if this pays interest every quarter, that's called your observation period. So on this first quarterly observation, as you can see, this first quarter, it shows that the indices, one of them is above, trading above where we purchased it, and one's below. The key to keep in mind, it's all about this barrier level. This is your protection level. And in many of the notes that we look at, the protection level is pretty significant for a reason, okay? So it's a 30% protection level, okay? The goal is never to break this, never to breach it. So if you can see quarter after quarter, at some point, one of the indexes got pretty darn close to that barrier level, but it never breached it. So two things are going to happen while you're in this note. One is each quarter, when they observe where these notes are trading, or excuse me, where the indexes are trading, as long as it doesn't breach this protection level, what's going to happen is you're going to receive your 2% coupon interest rate, and it's based on the principal amount that you invest. Okay, so each quarter you received it, and that interest is put into your custodial account in cash, and you have it. So let's take it all the way out to 12 months. What would happen if the note went to full maturity? Well, again, you'd receive your coupon of 8%, and you've been receiving it along the way. Okay, because it never broke that barrier. as well at maturity. Okay, and this is the key to your principal, only at maturity. If none of the indices broke that barrier, what's going to happen is you're going to receive your principal back. So if you put $10,000 into this note, you received your $10,000 back, plus your coupon payments along the way, totaling 8% at the end of the term. Okay. Now, I do want to preface it by saying that for many of you who've been in these notes, you've often experienced what's called your notes were callable. Okay. A callable note just means at any point in time, okay, usually after 3 months, because you have what's called a call protection period of at least 3 months that you know you're going to get 3 months worth of interest. But after that 3-month period, starting, let's say, in the second quarter going forward, the bank, the issuer, reserves the right to call the note. And all that means is your principal, let's say you put in $10,000, will be returned to you. There's no negative impact to you if the bank would call the note. And let's just say they called it here in this third quarter. You received 3 quarters worth of interest, the first, second, and third quarter. So you missed out on the fourth quarter's worth of interest, but you received your principal back. So you received 6% instead of the 8. And then we look to reinvest it. Okay. But what would happen? Let's kind of give you an example here. What would happen if at some point in time that this last, the last index that we're in, at maturity, because your principal is only looked at maturity. So let's just say at maturity, that one note, or excuse me, that one index that we were tracking fell somewhere below this threshold, okay, below this threshold, maybe even by 1%, but it breached that protection barrier level. At maturity, your principal will be at risk, okay? 1 for 1, it'll be at risk, okay? But the important thing to look at is twofold. It's only at maturity. So along the way, from the inception all the way through, what oftentimes I'm asked, well, Cristina, what if one of these indices broke the barrier level in the second quarter? Is my principal going to be at risk? No. Okay. The only way it'd be at risk is if you call us and said, Cristina, we want to cash out. Okay. But we would never advise you to do that. So it could go below this threshold at any point during the term, but it's really only looked at maturity. So again, if it breaks that cushion at maturity, principal is at risk, okay? The one thing that I will point out as well along the way, let's just say one of these indices broke the barrier back here, maybe, you know, a little short after the first quarter, okay? One of them dropped way down, okay? All that would happen at that point is you would not receive your coupon interest for that particular quarter, okay? So let's just say if it broke it at some point in the second quarter, this interest payment, you would not receive it for that quarter. But should the index rise back above, somewhere up here, above that 30%, then you can certainly start resuming to receive your interest payments. So that is the only thing that could happen between the issue and before it matures, is you can miss out on the coupon payment, okay? But as far as your principal is concerned, it's only looked at this 12-month at maturity, okay? So the key to understand with these notes, again, is that the goal of it is to marry two things, is to find some competitive interest, which we certainly have. I mean, we've been seeing in the teens, if you can believe it, of interest rate. But it's not just that, it's to put a very deep protection level to help our clients. Now, I do want to preface this by saying that, you know, when these notes are structured, it's important to understand the mechanics behind how these issuers really get paid, so to speak, when they construct these notes, okay? Because we all know if we go buy a CD at the bank, right? But we don't necessarily see a fee for buying that CD or investing in that CD. But we know the cost for that is that the banks go out and they can loan our money out at double digits, okay? So the easiest way to think of how these banks, these large investment banks, are paid on the onset of the issue. Because what's important to understand is that these aren't like mutual funds where they have management fees embedded in the investment. This is a upfront, one-time cost. So the easiest way to think about it is when you buy a home. What is the cost that the mortgage company charges us to give us that loan? Does anyone know what the fee the mortgage company charges when they underwrite that loan? Points. Okay, that's something that we could use to help lower the interest rate. We pay those points. But what does the mortgage company charge us to underwrite that loan? Closing costs, yes. It's called an origination fee. Okay, they charge that fee at the onset to underwrite that loan. That's exactly how it works with the banks. They charge an origination fee, okay? And how it equates to the consumer is it's an adjustment in the interest rate. So let's just say very easy, if a note was paying 9% and their origination fee was 1%. Well, you're not seeing that 1% coming out of your principal that you invested. It's going to just be a reduction in the yield, in the interest rate that bank will pay on the note, okay? That's really how it works, plain and simple. But going beyond that, after it's issued, the yield that you get, if it's 8% for the year, that's what you're going to receive.
Okay, that was awesome, Christina. I just want to interrupt politely and respectfully because there's a couple questions and it's getting to be close to 6. Brenda asked a question about basically the barrier. And so to understand it, that black line that Christina had where it was 0, that's the line that the banks will look at every quarter. That line represents where the S&P was from the day you bought it, or the Russell 2000. Okay, so whatever the stocks or the indexes you're buying, that black line in that graph that she went over represents the day that was bought. That black line is where they're always going to look. Okay, 3 months later, the banks are going to look, where is the S&P and the Russell 2000 right now compared to when it was bought? As long as it has not dropped more than 30%, you're going to get a payment. And she referred to that as the barrier. It's protection. So it could go down 20%, 25, 29%, and you're still going to get paid. The other question was, Chris had a question about how much is at risk if broken at maturity? Well, whatever it is, the 30% is protected, but dollar for dollar, like Christina was saying, I'll give you an example. You invest $50,000. And if it goes to maturity, which many notes are not going to maturity, but let's just say it does go to the maturity, it's never called at maturity, and the protection was 30%. If it's down 40%, one of the indexes, then your principal is down 40%. You invested 50, it's down 40%, $20,000, you'll receive 30,000. You will have received the interest if it paid it or the coupon. So I hope that answers. So how much is at risk? If it goes below the 30, that's what is at risk, 31%, 35, 40.
Yeah. So that's a good point, Nancy. And again, we're very mindful of, especially what we've just gone through with, a large degree of volatility. Anytime you look at a normal market environment, a 10% swing plus or minus is normal movement in the market. We just call it noise in the market, right? But when you experience what we've seen, certainly in the last month or so, the degree of volatility, many of these notes have seen that degree of volatility. Okay, absolutely. Okay, but again, it's not affecting our clients because it hasn't approached its maturity date. Many of these notes, that are held right now in our clients' portfolios aren't maturing into next year, and some of them in 2 years from now. So we want to be very mindful of that as well. I saw a question come in too about who sets these barrier levels. Did you see that one, Nancy?
Yes, I answered that to Mike. The banks do, the issuer,
Oh, okay.
the issuer. And there's another one from Dave and Pam. If it broke the barrier at one point during the period, finished above the barrier, is there no loss of principal? Dave, that's a great question. So you could lose maybe a coupon, a quarter's worth, or if it paid monthly, if it dropped below that protection. But as long as if all of the indexes or stocks were at down 29.5%, your principal is protected at maturity.
Yeah.
And a lot of you on this call do have notes, so.
Yeah. Yeah.
I do as well. I love them. It's just, yeah.
And you know, what Nancy and I do a lot of too, is we customize these notes for our clients. So twofold, the issuer can set the barrier levels in the coupon, the interest rate that it will pay. But oftentimes Nancy and I set those parameters, and we'll say, hey, we want a 30% or 40% protection level, and we want, 12% coupon rate. And so everything's kind of an ebb and flow. Think of it this way. If you want more protection on your principal, what do you think you're going to give up? You're going to give up a little bit more of the upside of the interest, right? And vice versa. If you said, well, I'm willing to give up a little bit more of the protection of my principal to get more interest. So it has a balancing act. So, yep.
Awesome.
Any other questions?
Oh, it looks like there's one more question from Terry.
Terry, if a note falls below the barrier level prior to maturity, can the issuer call the note while the note is below the barrier? They can call it at any time.
But you won't be affected. Even if it's below that barrier.
That's a good thing.
Yeah, if the issuer calls a note, it's called at par value, meaning you put 10,000 in, you're getting 10,000 back.
And you're right. You're right, Chris. I think it is a good hedge. I mean, Cristina and I bought a bunch of notes the last week in January, so that we thought, yay. So that was pretty cool. And I know a lot of the people on this call, their notes have been called. And guess what they did? They just bought some more. So yeah, it's for a slight portion of your portfolio.
Okay, well, I'm going to pop back in now. So if there's still questions out there that did not get answered, you can always call our office and schedule a complimentary call. If you're a client, obviously it's complimentary. But even if you're not a client yet, you can do that. I put the link in there for a 15-minute call, or just give us a call, look at the website. I want to remind you guys again that our next happy half hour will be in 2 weeks on February 21st. We'll be talking about the psychology of money. And if you're enjoying our happy half hours, please spread the word. We're growing every week. More and more people are joining us. It's fun. It's a half an hour of your time. You get to have a drink while you're listening to us. It's just a good way for us to stay connected to our clients and for prospects to get to know us. So that's why we do it. Now it's about time for our happy half hour. I still did not hear who owner was. It's hard for me to put you into the drawing for the bottle of wine if I don't know your name. So in the future, if you're on here and you're kind of incognito, send me a private message so I know. All right, let's see who's going to be this week's happy half hour wine winner. Who's the lucky winner this week? It is Tom P. Yay.
Right.
All right. Congratulations, Tom. I will be reaching out to you tomorrow to learn a little bit more about the kind of wine that you like to drink, and we'll get that bottle sent off to you as soon as we can. All right. Wow.
Okay, everyone.
5:58. So we even have a minute or two. So it was a great week. If anybody has any questions, again, let us know. And we look forward to seeing you guys again soon.
Be well. We'll see you next time.
All right. Take care. Have a good night.
Bye-bye.
Bye.